Hi everyone. My topic for today's video is policy framework for international trade. Broadly, yeah, before we go to the policy framework, what is the significance of foreign trade policy? International business operations, they are considerably influenced by the policy measures of the government. They are employed to regulate trade both at home and host country. Exportability and importability of the firm's goods are determined by the trade policies. So, if trade policies are favorable, companies may be able to export more goods. If trade policies are unfavorable, the companies may not be able to export more goods. Then, price competitiveness is also impacted by the trade policy, that is import and export tariff policies. Policy incentives help exporters to increase their exports and therefore their profitability will increase. The host country's trade and FDI policies often influence entry decisions in the international markets. Now, coming to the options for trade policy for the government, the most famous and the most popular are the two broad options for the trade policy: inward looking strategy and its opposite, outward looking strategy. What is inward looking strategy? Inward looking strategy is nothing but the strategy of substituting import. So, what government does is rather than promoting export, they go for saving the foreign exchange, because foreign exchange is always in shortage for an underdeveloped country or a developing country. So they want to reduce imports. Money spent is money saved is money earned actually. So that is the maxim. And now we are having Atmanirbhar Bharat scheme of Professor Prime Minister Modi. This is also like import substitution. He wants India to be self reliant and self sufficient. Then there is outward looking strategy, it is export led growth. In this, the government tries to promote more and more export. Actually, after independence, under the Nehruvian model, we had more of inward looking strategy because we needed foreign exchange for importing machinery, technical know how for the development requirements, and our industries were not that efficient or competitive enough to export goods, and therefore we followed inward looking strategy. It is also known by as different names, like we have to become self-sufficient, self-sufficiency in trade, and so on. And slowly in 80s and in 90s, it was realized that just import substitution strategy is not enough. We have to actively promote our export, because our industries were becoming more and more inefficient. They were not competitive enough. They were supplying inferior products at higher price. And all this led the government to change the strategy to outward looking strategy. Now, government follows broadly demand versus supply side policy measures. Demand side initiatives include export promotion, which include programs to alert companies regarding the opportunities in the international markets and to strengthen the commitment and skills to those who are already involved in exports. Then there are supply side initiatives. They include creating and expanding export production. So we have to increase the production for exports. Our goods must be competitive, quality must be good, and competitive price. Developing transport networks, port facilities, tax and investment systems. All this come on the supply side initiatives by the government. Now, coming to instruments of trade policy, we have broadly two categories of measures: tariff and non tariff measures. And we can also talk of financial controls to formulate to make use of the trade policy, to implement the trade policy. Then what are tariffs? Official constraints on imports of certain goods and services levied on levied in the form of customs duty or tax on products moving across borders. We can say mainly they are import and export duties, tariffs. Classification of tariff instruments. On the basis of direction of trade, we have import versus export tariff. So when you are paying the tariff for importing the good, it is import tariff. And when you are paying the tariff for exporting the good, it is export tariff. On the basis of purpose, we have protective versus revenue tariff. Protective tariffs are imposed to protect the domestic industry from foreign competition. Revenue tariffs are imposed to generate revenue for the government. Normally, most of the governments they impose protective tariffs and not the revenue tariff. On the basis of time length, we have tariff surcharge versus countervailing duty. Countervailing duties are imposed only when some country is dumping their goods in our country. What is dumping? Dumping means selling the goods in the foreign country at a price lower than the cost of production or at a price which is lower than the price at which it is sold in the home country. Now, if any country is dumping their goods in other countries, the other country, as per WTO rules and regulations, can impose anti dumping duties or countervailing duties so that the domestic product doesn't become uncompetitive. Then tariff surcharge. These countervailing duties for limited period of time as long as the other country is dumping. Tariff surcharge is continuous basis. On the basis of tariff rates, we have specific ad valorem and combined tariff. Specific tariff is on the units. That is, per unit, you need to pay so much. So if you have got the multiple units, it is the tariff amount multiplied by number of units you pay the duty. Ad valorem duty depends on the value of the product. Maybe 10% of the value you have to pay as a duty, and combined in which the government combines both ad valorem as well as specific. On the basis of production and distribution points, we have single state sales tax, value added tax, cascade tax, and excise tax. But actually, now we have only GST. All the other taxes are merged with it. Then we don't have even turnover tax as well. Then there are non tariff measures. Non tariff measures are contrary to tariffs, which are straightforward. Non-tariff measures, they are non-transparent and obstruct trade on discriminatory basis. So sometimes what government does is they may impose quotas or totally that there may be ban on import of certain goods from certain foreign countries. So they are discriminatory. We are discriminating on goods and the countries. From other country, that good is allowed. From so and so country, it is not allowed. So under WTO norms, non-tariff measures are not permitted. Major non-tariff policy instruments, government participation in trade. So government will trade rather than allowing it to be left to the private sector. Customs and entry procedure. Sometimes customs and entry procedure is very difficult. It takes some 40 days, 50 days. So it is a demotivation for the exporters to export their goods to our country or for the importers of our country to import goods from foreign country. Quotas, absolute quotas may be given to the companies, that is they cannot import more than that. Then there will be other restrictions like total trade ban. Voluntary quotas, a voluntary export restraint, VER. is government imposed limit on the quantity of some category of goods that can be exported, and this is also referred to as export visas. Tariff quotas. A tariff rate quota, it is TRQ, is a two-tiered tariff structure which combines the elements of both tariff and quota. Under this regime, a lower tariff is permitted up to certain specified quantity, and if you are importing more than that specified quantity, you have to pay higher tariff. Like let us say on importing certain variety of maybe smartphone, for first 5,000 units you have to pay maybe 10% of tariff. If you want to import maybe up to 10,000, you have to pay 30% of the tariff. So here you have the quota 1,000 and then another quota, and you have the tariff both. So it is combination of tariff and quotas. Thanks all of you for watching the video. Any comments, suggestions, please write it down in the comment section.